Hey, what's up guys? This is the Smart Money Technician and welcome to today's video. Now in today's video, we are going to be continuing what we did, but in this video, I'm going to try to explain everything from scratch in a very comprehensive way. That way you know and understand what we are dealing with, because I did get some people reach out to me and they told me that, bro, the stuff that you're teaching is a bit confusing, right? So I'm going to do my best to explain this as best as possible. But before we get into this, so that you know that you are not just wasting your time watching this video, I need you to know that the stuff that we are teaching in this video most definitely works, right? So last video, what did I say? I showed you guys, first of all, how we use the concept talked about in this tutorial, how we use them to pass challenges last week. And I said that we are going to pass more challenges again coming into the next week, because it's the same thing over and over every single week. It's always there. And lo and behold, you can see we passed in Tradeify. Now, Tradeify, they don't give any certificates for the kind of account, the growth account, which is weird. Like, what's the point? Why don't you just give a certificate? But anyway, that's beside the point. We passed those accounts as well, right? We also passed another funded next account as usual, right? So I'm not really into showing profits. I just want you guys to see that, hey, if you can pass this account, surely you can get payouts. Because I know some of you guys have been trading these prop firms for a long time and you've been losing money. So if you learn and you master the things talked about in this video, trust me, you will get your get back with these prop firms and you will be able to turn around the losses that you have been incurring and turn them into profits. So make sure you lock in, take notes, watch it over and over again so that you fully understand the things that have been talked about in this video. And you too can also do the very same things that I'm doing. All right, so the first thing we will talk about is SMT divergence, right? Just regular SMT. It can be sequential. It can also be a regular SMT. That's beside the point, right? So this is when one asset comes and takes out a low, right? Over here, you can see it takes out this low, while in a correlated market, it fails to take out that low. Another thing that you need to pay attention to is that this low is not some low that is far away, right? Again, I said before, the low that you are gauging your SMT with on the time frame needs to be within 30 bars, right? So it can't be some low that is far away, like from weeks ago. Because like I said before, that is like you seeing price take out a monthly high and you're using a 1 minute break of structure to try to get alongside that move. It doesn't work, right? So SMT divergence, this is the kind of SMT divergence, regular swing high or swing low SMT divergence. That is the first thing that you need to know. Price takes out the low in one asset, price fails to take out the low in a correlated market. That is when you get the SMT divergence, and you will expect the market is going to reverse from there, right? Obviously, you're going to look for further confirmations, which we are going to discuss in the video, right? So the next crack in correlation that we're going to be discussing is SMT fill. This is when you have a gap, right? We know what a fair value gap is. You can see that a fair value gap is when the candle 1 and candle 3, right? This is candle 1, candle 2, and candle 3. They do not meet one another. They're encapsulated in candle 2, forming a fair value gap. And then what you are going to see is that price in one asset is going to trade into that gap, while in another correlated market, it's going to fail to trade into that gap, right? This is another kind of cracking correlation that we use and we pay attention to. Again, the low, which is the entry of the gap, should not be far away, right? We don't want it to exceed 30 candles or 30 bars relative to the time frame that we are viewing it on, okay? You don't want to see some gap that is far away in price and then you're trying to see that there is an SMT fill taking place there. No, it is near-term gaps within 30 bars that we are considering, okay? So this is very, very specific, and I need you guys to pay attention to this kind of SMT fills, right? There's also another sequence, right? It's a very powerful sequence, right? Where you can see over here, this is candle number 1, candle number 2, and candle 3 of the fair value gap, where candle 3 is a PSP, meaning in this asset, it might be bullish, and then in another asset that is correlated, it is bearish. And then candle 4, notice I did not say candle 5, 6, 7. I say candle 4. Candle 4 then trades into it, right? And in another correlated asset, candle 4 fails to trade into it. So you have like a SMT fill taking place, but also an SMT between the PSPs. That, my friends, is a very, very, very powerful entry technique. And I'm going to show you, there's going to be an example of that. That is a very powerful continuation sequence. But all in all, SMT fill is when one asset trades into the gap, another asset fails to trade into the gap that is correlated to that asset, right? SMT fill divergence. All right, so now when it comes to SMT, as you can see, this is a regular SMT. You always want to have a second stage, something to confirm the original SMT idea that you are seeing in place. So a second stage can come in multiple forms. It can come, as you see an SMT here, right? So in another asset, this level, right, price takes it out here, but in another asset, price is failing to take out that level right there, right? So this level can either be a low or it can be a gap, as I previously showed you, right? So price takes out the low, right? And then we have SMT divergence taking place there. And then what can happen is that this candle over here, fails to take out that low, while in another asset, that same candle takes out that low that caused SMT. That I call consecutive candle SMT, right? Where the immediate next candle fails to take out the low, right? So that can be a second stage. So your first stage, regular SMT, second stage, consecutive candle SMT. Or you can have a situation where you have the SMT taking place and then a precision swing point is going to confirm it. So this candle is bullish in this asset, whilst in another asset, it is bearish, confirming the SMT. So that is another form of a two-stage, right? And then there is a variation where, let's say you have a gap or you have a low, price trades into the gap and forms a precision swing point. It doesn't form SMT with the level, it forms a precision swing point, and then the next candle opens, right, fails to take out the low of the precision swing point, whilst in another asset, right, you're going to get that candle taking out the low of the precision swing point. So it's like a SMT between the PSPs. It's basically a two-stage PSP is what I call it, right? So there are multiple variations, and this is not all the variations. There's even another variation where you have an SMT and then price comes back again. Let's say price consolidates and does not expand. So that's a failure to manipulate, or I mean, that's a failure to expand in our direction, right? So we are going to require one more run through this low, and what you will see most times is that that also has a second SMT. So for instance, you can have price giving an SMT here and then price retracing, not taking out the low here, while in another asset, it is taking out that low. So you have another second stage. It's multiple variations. The more you mark charts, the more you will see all the different variations of it, right? Now, along with SMT divergence, which we use to indicate that price wants to reverse, we also use swing formations. So over here, we have what we call the C2 closure, or the candle 2 closure. Basically, it is when you have candle number 1 and the candle number 2 takes the low of candle 1, but it doesn't close below the low of candle 1. It closes inside the range of candle number 1. This then indicates that price wants to reverse higher. So we would look to trade candle 3 in this case, where we would anticipate that candle 3 is going to fail to take out the low of candle 2 and get rejected somewhere in its range and then expand higher. So we look to trade candle 3. When we see that candle 3 expands higher, right, we can then also try to trade the fourth candle, which is candle 4, right? And we also expect it to reject inside the range of candle 3, right, expanding higher. So this is the C2 closure, right? And one thing that you need to pay attention to, especially for the C2 closure, is that the wick on the low is long. That's how you know that there was significant rejection inside of this level, indicating that price wants to trade higher, right? Now, we also have the candle 2 reversal into expansion swing formation, right? This is when we are at or near a relevant key level, right? And then the candle 2 opens up and takes out the low of candle 1 while also being in the relevant level, which can be an old low or a fair value gap, right? And then it expands. The key to this particular kind of candle is that it has a small wick, because when it has a small wick, it supports expansion, whereas this one has a long wick. So it's technically the same candle. The only difference is that this one has a small wick. As you can see, it takes out the high, but the wick is very small, so it supports expansion. And we can look on the lower time frame to try to catch this particular candle. You understand? So this candle supports expansion, so we are able to catch it on the lower time frame. Now this one, right, we usually wait for this candle to rather close, and we'd rather trade candle 3. Right? That's how this one functions. Now, there is actually a way, I'm not going to lie, there is a way to trade this particular candle, right? And you need to trade it at the wick of it, right? If you want to catch the C2 candle, but you need to be on the advanced side of things. I will show you how you do it, right? But the safer thing is to simply wait for the candle to close, especially when you see that the wick is long, right? You wait for the candle to close and you rather trade candle 3 because that's the safer thing to do, right? So that's how that candle works, whereby this one, because the wick is so small, you can trade the candle already if you find a lower time frame swing formation that confirms it, right? So this is the C2 reversal into expansion candle. Then we have the C3 closure, right? This is when we have candle 1 and then we have candle 2, but candle 2 does not close within the range of candle number 1. So we don't know if this candle is going to reverse. So what happens is that we have to wait for this candle to close, right? So basically what happens is that this candle fails to take out the low of candle 2, but then it closes past the opening price of candle 2, right? So we wait for this candle to close, and when it closes, we can then trade candle number 4, right? Again, I will say this again. If you are advanced, there is actually a way to know that this candle is going to fail to take out this low. There is a way, I'm going to show you that, right? But the safer thing to do, right, is to wait for the candle to close, right? And then you trade the fourth candle. That is the safer thing to do, the beginner thing to do, okay? So you will trade candle 4 because candle 3 confirms it as a swing low because it fails to take out the low, closes above the opening price. We can then trade candle number 4, right? Very simple. All right, so now we're discussing invalidations. So when we have a swing formation, right, we have an idea that we are anticipating a specific move to take place in the market. We now have to set an invalidation to that idea. So over here, you can see we have a C2 closure pattern, right? Now, the way we mark the C2 closure, right? In this case, can you see that this candle, the closing price, which is there because it's a bearish candle, and the opening price, notice that the closing price is lower than the opening price, but it still also closes below the range of candle number 1. So it's still a C2 closure. But whenever you have a situation where the closing price is lower than the opening, right, then you are going to mark the close all the way to the low, right? And you get the equilibrium, which is the midpoint. So when the next candle is going to open around here, because that's where it closes, so the next candle opens here, you want to see then price open, might trade lower bit, right? But you do not want to see it get to the midpoint. You want it to get rejected in the upper half and expand higher, right? Whereby in this candle, it is also a C2 closure, but can you see that it closes as a bullish candle, meaning that the closing price is above the opening price, but it's a C2 candle. Whenever you have the situation, you can just mark the entire range of the candle, and then you get the midpoint. And when the next candle opens here, right, you want to see it open. It might trade lower a bit first, but you want it to respect the upper half. You don't want it to get to the midpoint or below the midpoint, right? Then you want it to get rejected in the upper half, and you want candle 3 to expand higher, right? So think about it, right? Over here, if we were to mark out the entire range of this candle, and price is opening here, and it was going to trade down, it's already going to be at the EQ of this candle's range. That's why we mark this candle this way. We mark it by the wick, whereby this one, we mark the entire candle because of the nature and the way it closes, right? So this is how you get your invalidation point for the C2 closure candle, right? So here we have candle 3, right, which is an expansion candle, right? So price expands and we still have lower objectives to reach, and we're anticipating that price still will trade lower. This is where we would anticipate that candle 4 is still going to expand even lower. So if that is the case, you're going to expect that candle number 4 is going to get rejected inside the lower half of candle 3. So basically, you take the range of candle 3, you get the EQ, which is the equilibrium or the midpoint, and you want to see candle 4 get rejected in the lower half and continue to the objective that you have to the left of the chart, right? Same thing in the bullish scenario, right? We have the candle 3, which was an expansion candle, but we still have upside objective. So we anticipate that a candle 4 is going to form, and we want to see it get rejected in the upper half of the candle, right? So we take the range of candle 3, we get the midpoint, the EQ, the equilibrium, and we want to see candle 4 get rejected in the upper half, then trading to the objective that we have outlined, okay? Now, whenever we mark a candle in our swing formation sequence, right, and we expect the next candle to get rejected in that candle's range, right, can you see this upper half of this C2 closure candle swing formation? On the lower time frame, inside of this range that we marked, you want to see a fair value gap resting there. So when candle 3 opens and trades lower, what is actually happening on the lower time frame is that price is opening, trading lower into the gap, getting rejected in the gap, and then trading higher, right, to the objective that you are anticipating the price is going to go into, right? So essentially what I'm saying is that inside of this upper half, which is our invalidation level, our invalidation range, you want your fair value gap to be in the upper half of it. Same thing with this candle right here, right? You can see the upper half of it over here, right? If we go over here, you want to see the gap be in the upper half and price open on the next candle, trade into the gap, give you some kind of bullish confirmation, whereby it could be a swing point, a swing formation, S&T inside of the level, and then you would anticipate that price is going to get rejected in the upper half, which is the gap on the lower time frame, and then trade in the direction that you are anticipating that price is going to go into. Okay, very simple things, folks. So the reason that we do this, right, is because sometimes, let's say we've marked our invalidation range, right? Sometimes the range is actually very large. So to refine that range, we find a gap inside it on the lower time frame, and then we would anticipate that price would get rejected in that level, right? This is what we call our refined key level. So when we put everything together, right? Say for instance, you have some kind of reversal signature, perhaps this SMT, and then a swing formation form in the form of a C2 closure, right? Then you get your invalidation range. On the lower time frame, you want to see some kind of gap inside of the upper half. Price opens on candle number 3, trades. Price opens up on candle number 3, right? And trades into the upper half, which on the lower time frame is really it just trading into a gap and then expanding higher, right? Then once you get that confirmation of candle 3, you could have taken a trade in there. and candle 3 is an expansion candle like this, you can then check to see if you still have upside objective to the left. If you do, you then anticipate that candle 4 is also going to trade higher. So you then take the range of candle 3, you get your invalidation range, you find some kind of gap on the lower time frame for price to get rejected when candle 4 opens, and it then also expanding into the level that you were anticipating. Okay, now we get to our framework. Now, every trade that we take will either have one of the different frameworks. This is what I am always envisioning in my mind when I'm taking a trade. So the framework really takes place on the higher time frame, although it can also be showcased on the lower time frame. I'm also focused on the higher time frame framework, right? So the first framework or model that we have is what we call internal range liquidity to external range liquidity. So over here, you can see that price retraces into internal range liquidity, which is a fair value gap, right? We get some kind of reversal signature, right? And then price then trades into external range liquidity, right? That's the first framework. So the next framework that we have is external range liquidity to internal range liquidity. So this is where you have price taking out a high or even a low, right? And then you get some kind of reversal signature there. And then price, you will anticipate to reverse back into internal range liquidity, which is this gap over here, right? So price goes from external range liquidity to internal range liquidity. Now, I will say this, there are obviously times when it will expand beyond your internal range liquidity, but you want to always take your targeting in stages. So first things first, you would see a reversal signature, and then you spot a fair value gap that is in the discount of this range, right? So when you get your reversal, right, you would anticipate that price is going to expand into an internal range liquidity, right? So if it then shows no signs of reversing at the internal range liquidity, then you can obviously target beyond the internal range liquidity. All right, so this is external range liquidity to internal range liquidity. And then the last framework is what we call order pairing ranges, right? This is basically when you have a price taking out a range low or a range high, right? But you don't really see like any internal range liquidity to target. More so, price is more so in just a consolidation, right? And the way you would know that is if you see to the left of the chart, which is your targets, you see failure swings. So can you see that this high is very close to that high over there, right? So you get price getting into the range low or the external range liquidity. You get a reversal signature in here, and you would then target the opposite end of the range, right? So this is what we call order pairing ranges, because we are pairing one side of the range, we're buying, and we're looking to exit our buy that we got over here in the opposite end of the range, right? So that is the way this one works. What makes it high probability is that it has failure swings as along the way of your targets, right? That is what you want to see. So essentially what we are doing is that we are applying SMT and swing formations to these different frameworks. So for example, right, you see price taking out the external range liquidity. For instance, there may be SMT between the high and where price is taking that high over there, right? You can see SMT, and then you get like a C2 closure, for example, right? Once you see a C2 closure, you see that below the market you have a fair value gap. So you can take the range of the C2 closure. You expect price to get rejected in the lower half in this case, right? On the lower time frame, you would probably see a gap inside that lower half, right? And then price will then get rejected into the internal range liquidity, for instance. Or for instance, right, here we are going from internal range liquidity to external range liquidity. So perhaps there was a SMT fill when price trades into this internal range liquidity, which is this gap, and in another asset it did not trade into that gap, and perhaps there was some kind of PSP. So you have a two-stage at that key level, right? And what happens is that you see that candle 3 fails to take out candle 2, and then it closes above the opening of candle number 2, forming a C3 closure. So you then obviously would see that, okay, I still have upside objective, which is the external range liquidity, right? So I'm going from internal range to external range liquidity. So you mark out the range of candle 3, and on the lower time frame, you would get a refined key level inside of this candle, right? And you would expect that candle 4 would get rejected in that refined key level and then expand towards your target, which is your external range liquidity. So this is an example of order pairing ranges. So as you can see here, this candle 1 is already at our swing low, which is our key level, right? So we can see that the next candle, right, opens up and it takes out the low of the previous candle, but it also has a small wick. So it then supports expansion, right? So on the lower time frame, you can possibly use another swing formation to catch the low of the wick, right? But let's say you did not do that, right? But there was like SMT and a PSP that confirmed this level. There was some kind of two-stage sequence that confirmed this. Price then expands as a C2 reversal into expansion candle. Okay, and you can see to the left, you still have your targets that are there. You would then take the range of the C2 and anticipate that C3 would then open, get rejected inside the upper half, and trade to your range high, right? Your external range liquidity. Obviously, you would see that there is a lower time frame gap or key level that is going to cause price to reject in the upper half to get to your objectives, right? Now, if you actually think about this, right, you will realize that this is the mechanical way of envisioning a market maker model. So if you look on the lower time frames, you will see all this as a market maker model, but when you're looking at it through a higher time frame lens, it just appears to be swing formation candles that are applied to key levels. All right, so I don't want you guys to think that we have left the things that we were previously talking about. This all dovetails nicely together, right? So now we talk about time frame alignment. So I created more so a mechanical way of just envisioning this in my mind, right? Because ultimately, whenever I am engaging price action, I always have it in my mind what I am seeing. For instance, on the higher time frame, I see that a potential internal range to external range liquidity. Okay. Then I ask myself, within this framework that I am trading, right? What candle am I currently trading in? Okay, I've seen a C2, so I'm anticipating that the next candle is going to be a C3. I see the SMT is taking place. I see the target that I'm targeting. These are the things that I am envisioning in my mind when I am taking a trade on the charts, folks. So the way that you can simplify this for yourself is to see this as 3 time frames, right? You have your higher time frames, right? And your higher time frames is your weekly, your daily, your 4 hour, right? And it also has a secondary higher time frame, which would be the H6. So this is, let's say, I didn't really see anything on the H4, then I would also consider like the H6 to see if there's anything there. And this higher time frame, I use this time frame to try to get a framework slash narrative, right? So for instance, let's say I see price take out some high on the weekly and form a C2 closure, and then I'm anticipating that the next week is going to be a C3. So for instance, let's go into this, right? So for instance, let's say this is the weekly time frame, right? So what will happen is that on the weekly time frame, you see that price takes out this external range liquidity, but also closes as a C2. Perhaps there was SMT there, there was a PSP that confirmed that price wants to reverse at that level the next week. You would then expect a C3. You see how this ties in together, right? So I use the higher time frames to get some kind of a narrative, which is your internal range to external range liquidity, your order pairing ranges, or your external to internal range liquidity, right? And then your middle time frame is what I call the setup time frame. It is technically the exact same thing that is going on. You're going from internal to external range or external to internal range or order pairing ranges, right? But I do not go to this time frame unless I have already gotten something on one of these time frames over here on the higher time frame. So on the middle time frame, that is the H1, the M30, or the M15, and we only use the M15 when we have some kind of a two-stage on that M15, right? So keep that in mind. And the secondary middle time frame would be the 90-minute time frame. So perhaps I didn't see anything on H1 or M30 or M15, then I will consult the 90-minute time frame, okay, to find some kind of signature there as well, right? And then we have the lower time frame, which is your M5, your M3, and your M1. This time frame is primarily used for entries, right? So you want to see some kind of impulsive CSD, right? So let's look at how that would work, right? So time frame alignment matrix, right? So you use the daily swing formation to confirm a weekly swing formation. What does that look like? So what that would look like is, say for instance, right, we have some kind of SMT, PSP, some kind of two-stage confirming a level to the left that we can't see obviously here, right? But then we get a C2 closure on the weekly time frame, meaning that we are expecting that the next weekly candle will be a C3, meaning that it's going to fail to take out the low of this candle and it's going to trade higher. And we want to see it get rejected in the upper half. So we mark the invalidation range and we get our refined key level in the upper half. And where do we get the refined key level from? Since this is the weekly time frame, we will then go to which time frame? The daily time frame. That is where we get this refined key level that is in the upper half of the weekly candle on the daily time frame. Or for instance, you use an H4 swing formation to confirm a daily swing formation. Again, what that would look like is you have some kind of SMT, PSP, two-stage confirmation, confirming a key level to the left, right? Perhaps we're going from external range liquidity to internal range liquidity or internal range liquidity to external range liquidity. The point is that on the daily time frame, we get some kind of reversal signature, right? And we now know that this daily candle is a C2 closure. So we anticipate that a C3 is going to form, getting rejected in the upper half. So we get a refined key level, and we find that refined key level, since this is a daily candle, you go down to the H4 time frame to find some kind of gap in the upper half, so that on H4, when price opens up, it trades down into that gap that is found on H4 and then trade higher, right? But on the daily time frame, you're just going to see one bullish candle expand as a C3, whilst on the lower time frame, which is your H4 in this case. Since we're dealing with the daily time frame, you will see that price is going to trade into a gap and then trade higher. Or for instance, you use a 90-minute H1, M30 or even an M15 swing formation to confirm an H4 or a H6 swing formation, right? And essentially it is the same thing. You have some kind of two-stage cracking correlation that is confirming our framework, perhaps internal to external range, external to internal range, or order pair ranges, right? You see that taking place on the H4. So you see your swing formation there, right? And then you get your refined key level. Since this is the H4, you look on the 30-minute, the 1 hour, the 30-minute or the 15-minute, but also sometimes the 90-minute time frame, right? And this H4 sometimes is also an H6, right? Candle closure, right? So I'm going to show you an example when it's H6. You can really, when you get to the H6 or H4 and you're trying to find refined key levels using either the 90-minute, the 1 hour, the 30-minute, or the 15-minute, one thing I've noticed is that for this particular time frame, you can really mix and match a lot because there's not much of a difference between the 90-minute and the 1 hour, or the 1 hour and the 30-minute time frame, or even the 30-minute time frame and the 15-minute time frame. Although I only use the 15-minute time frame if I see that 15-minute time frame is also giving its own separate two-stage setup as well, right? So keep those things in mind. I hope it doesn't confuse you. It's just a whole bunch of mixing and matching, but it is the same protocol. It's mechanical. So listen to what I say carefully, write it down so that you know exactly what I'm saying, right? So once you've confirmed the setup right over here, right, you then go to what I call the entry time frame. So that is the M5, the M3, or the M1, where you want to see a change in the state of delivery take place. And it has to have what I call a V-shape signature, right? So let's look at that. So over here, right, say this was your H1, M30, M15, could even be the 90-minute as well, right? This is the setup time frame. Price traded into the refined key level, gave you some kind of SMT there. Could be SMT fill, could be PSPs, something two-stage over there. And then you see a swing formation form, right? Now, you would then go to the M5, M3, or M1, right, to get an entry. I'm also focused on M5 and M3. The only time I use M1 is when the CSD, because I'm always looking at the opposing candles and where I am anticipating a change in the state of delivery. If I see that range is very large, and even if it's CSDs there, my stop loss is going to be huge, then I will go to the M1, right? So anyways, basically, H1, M30, M15, you get your confirmation, you trade into refined key level, you get some kind of SMT, two-stage there, right? And the price gives you a C2 closure, right? As you can see, this candle closes back inside the range. It takes out the low of candle 1, right? And then it closes back into the range, right? So what will happen is that on the next candle, you can see over here, price will trade lower into the gap, right? And then it will then give you a CSD. When you get that CSD, right, you can then enter, as you can see, that was the entry, and you put your stop loss below the CSD. Now, usually when I see price get into my refined key level and I have some kind of SMT already taking place there and it is two-stage, I will actually try to catch this first CSD, right? I don't usually wait for the candle to really close if I've already seen a two-stage already. If I've already seen some kind of two-stage on the higher time frames, then I will take the first CSD. And the reason that I do that is because of this. You see the first CSD, right? I would enter as this price closes and I'll put my stop loss below there, so that when price then retraces, right, and then gives a second CSD, you can immediately take your stop that was here and you can put it below that low, trimming the risk. So what this does is that most of the time when you lose a trade, you don't lose your full risk. So if you were risking 1R and you trimmed your stop all the way to the second CSD and price came back and takes this low out, because if price comes back and it takes this low out, usually that would also mean that price is probably also going to take this low out, because you don't want to see deep retracements, right? So that's why you would trim your stop loss till there, right? So most of the time what is going to happen is that you are not going to take your full stop. And what that will do for your equity curve is that your equity curve will have very small dips when you lose, but nice expansion higher when you do win your trades, right? So you're trimming your losses to take partial losses instead of full losses. That's why I prefer the first CSD, right? And then for the second CSD is actually the higher probability entry. It is the higher probability entry because you are getting a confirmation that price is indeed going higher and the first CSD is valid, right? So it is a higher probability entry, but there is a give and take that the first CSD gives you the opportunity to trim your stop and sometimes even go break even very quickly, right? So as price expands in your direction, whether here or here, whether each one, whichever you entered on, if price then goes to like 2R, you would then put your stop immediately to break even and you would target whatever objective. I target 3R. But if you are targeting your framework's draw on liquidity, for instance, let's say you're targeting external range liquidity, or you're targeting internal range liquidity, or you're targeting a range high or range low for order pair and ranges, along the way, if you're holding for those full targets, you would then want to be taking partials along the way, okay, beyond 2R, right? So any highs or gaps or anything that exists beyond 2R, you can close partials there, right? And another thing that I want to add with regards to the trimming of the stop loss on the first CSD, right, is that when price gives you the CSD and you entered there, right, and then price is retracing. This retracement you want to take from the low of the CSD to the high where price is retracing from. You want price to at least get into the 50% and form a bulky opposing candle, right? You don't want it to be some skinny bodied candle that you're saying as a new CSD to enter on, because most of the time price does give those fake CSDs and then it will come down one more time to take out the low and still keep the low intact and then give a second CSD, and then that one is a bulky candle CSD, and then you can trim your stop to the low that it formed. So you want to always make sure that it at least got to the 50% so that you know that it is a significant retracement and the CSD that takes place here is a valid one with a bulky candle, one that you can trust placing your stop loss to. All right, so I want you guys to keep that in mind as well. Again, to summarize, we're finding SMTs, swing formations, right, on the narrative time frame, and then we're then going to the setup time frame, finding the same thing, and then on the entry time frame we look for a CSD to confirm what we then found on the setup time frame to confirm an entry and enter in the direction that we are anticipating. So now let's get into some examples on the charts. So over here we are on NASDAQ, and this is the day, the 7th of April on Tuesday, that we are going to be trading. And we can see that over here we have price over here on Monday taking out this high over here that was on Wednesday, right? So you can obviously see that that is a weekly cycle sequential S&T. But I said you don't need to have these things on your chart. All right, you don't need to have the quarterly theory indicator on your chart. You can visually see it just by looking at the highs. Like I say, with this method that I'm showing you, the trades that you are going to be taking will be the same as a quarterly theory student, but some of the trades that you take, a quarterly theory student will not be able to take that, right? Because you are using the 30 bars rule as well. So as you can see over here, if you look back to this candle, right, let me show you that. You can see that it is just 3 bars apart, right? So when this second stage takes place, right, you can see that it is obviously within 30 bars of the next cracking correlation. So you know that this second stage that takes place here is a second stage that the algorithm is considering in confirmation to what happens here, right? You don't want to see some far away high that is more than 30 bars and say, I'm seeing SMT over there, right? So you need to make sure that it is within 30 bars. Over here, we can see first SMT, regular SMT, second SMT, consecutive candle SMT. And you can see on the consecutive candle SMT, this candle that is taking out the high, it opens, we're already at the key level, right, which is the high, right? Price opens up and takes out the previous candle's high whilst we are already at the relevant level, right? What is that? That is a C2 reversal into expansion, right? Because it has a very, very small wick. You can see that. So we are anticipating that this day is going to be a C2 reversal into expansion candle. That's what we're anticipating. And what are we going from? We're going from this high, which is external range liquidity. Where would the target be? It would probably be this low right here, right? So it doesn't have to necessarily be a gap. You can have a high from this low all the way to the high that you get the cracking correlation at. You can see a low in between that range, right? And you can still say that that is your internal range liquidity. Now you don't need to see price get all the way here, because on the lower time frames you can find an entry and you can catch many R's, right? So I wouldn't this day target all the way here because that's far. You target the previous day's low. That is the easiest target to get, right? So that is what happened. So this candle over here, we are anticipating it to be a C2 reversal into expansion, because we can see this candle takes out the previous candle's high. So we also will treat this candle as a potential C2 reversal into expansion candle. So how do we confirm a daily swing, right? With a H4 swing formation, right? So we're going to go to the 4-hour time frame, right? And you want to see some kind of swing formation forming there as well. So over here, right, you can see that price, when we get the SMT, can you see that over there, right? The next candle fails to take out that high, and then it closes below the opening price over here, right? Forming that C3 closure, meaning that we can trade C4. But remember what I said, folks. I said that I will teach you how to be able to anticipate that this candle over here is going to fail to take out that candle's high, and it's going to be a C3 closure, right? I'll teach you how you do that. So the way you do that is that you see this previous H4 candle on the lower time frame of it. It has some kind of crack in correlation and swing formation towards the ending, keyword, the ending of its lifespan. Okay, so I will show you that right now. So we are currently on the 4-hour time frame, and remember the time frame that I say we go to. From the 4-hour time frame, if you are trying to confirm a 4-hour swing, right, you would use either the H1, the M30, or the M15, sometimes the M90 when you're not really seeing anything on H1, M30, or M15. So in this case, there was something on the M30 time frame, right here. So I'm going to show you that right there. We go to M30, right? So you can see that this high right here, Dow Jones takes out that high, fails to take out that high right there. Can you see that, right? While NQ and ES both takes out that high right there. Can you see that, right? And then right after that, we get what we call consecutive candle SMT. Remember, this is the 2 a.m. 4-hour candle. That candle that formed the candle 2 that I showed you on the H4 time frame. And I'm showing you how you know the next candle is probably not going to take it. So I said you'd use a crack in correlation and a swing formation towards its ending life cycle. So you can see that this is 5, and then 5:30 comes and fails to take out, and takes out that high, while price over here fails to take out that high right there, right? So you have consecutive candle SMT. This candle closes back into the range of this candle, forming a C2 closure, right? And then this candle just trades lower. So you can then see that when 6 o'clock opens, it's probably not going to take out this high, right? That is why on the 6 o'clock candle, it just continues going even lower than it did, right? So I'm going to show you how you would then trade the 6 a.m. candle, which is, let me show that to you. This candle that was, let me take this out. I don't want you guys to be distracted. You guys really need to pay attention, right? So I'm going to show you how you would then trade this candle, knowing that it's probably failing to take out this C2 candle, and this one is going to be a C3 candle, a candle 3 trading low. And I'll also show you how you would also trade this candle as well, right? So we will get into that now. So, right, the first thing that we see is that this candle failed to take out that candle's high, right? So we're anticipating that this candle is going to be a C3, right? And we've established why it failed to take out this candle's high, right? So for the 6 a.m. 4-hour candle, you want to ignore the first 2 hours, meaning from 6 to 7 and 7 to 8. Those first 2 hours, you ignore those time and you start trading only from 8 o'clock and onwards on this 4-hour candle. In other words, we're only really looking to trade the last 2 hours of this candle on the 6 a.m. 4-hour candle, right? So we're anticipating that this candle is probably going to be a C3 closure, right? So I want to show you what happens. We didn't really see anything on the H1 or the M30 or the M15. Actually, we did. Let me show you the 1-hour time frame, right? But something more important. So price expands, right, and forms that gap, which is what our refined key level, right? And then we did get a consecutive candle SMT to confirm what is going on, and that's why price then trades lower, right? But I want to show you on the 90-minute, because the 90-minute is even better, and it shows that particular pattern that I was talking about. So over here, you can see that this candle is a bullish candle, whilst in this candle on the 90-minute time frame is a bearish candle. This candle fails to take out that candle's high, right? While this candle takes out that candle size. So we have a 2-stage taking place on the 90-minute time frame. Why is it a 2-stage? Because this candle is a PSP first of all, and then this candle fails to take out the high of that PSP. So we have 2 cracks in correlation, and at the same time it is a fair value gap. So it's like a PSP with SMT fill. It's crazy, and it is one of the most powerful continuation sequences. The key to trading these kinds of continuation sequences within the 6 a.m. candle is that let's go back to the 4-hour, right? Guys, pay attention here that the wick is small, right? Whenever the wick is small, it is generally safe to be on the setup time frame. In this case, we're on the secondary setup time frame, which is the 90-minute, because it gives a very nice signature here. It is generally safe to find a setup where it retraces into a gap and continues within the same candle. Remember what I said, folks. Normally, we would wait for the candle to do what? Close. And then on the 10 a.m. candle, we would then look for the 10 a.m. to open and trade into a gap that is in the range of the previous 4-hour candle. But in this case, we're finding a entry on that exact same 4-hour candle. And to trade it this way, you need to make sure that the wick is small. Otherwise, if the wick is long, you will simply just wait for that 4-hour to close and enter on the next 4-hour candle open. Pay attention, folks. This is very, very, very powerful information that I'm giving you, right? So you can see we have a 2-stage over here. So once we have a 2-stage and we can see that this candle opens, is taking out that candle's high, we already are anticipating that this is a C2 reversal into expansion candle because it opens and takes out the high immediately, right? So that means that we can go to the entry time frame, which is M5, M3, right, to find a CSD to get alongside this move, right? So let's go to the M5 time frame. I want to show you. Now, can you see let's go back to the 90-minute time frame because I just want you guys to see that quickly, right? So this candle right here is the 9 o'clock candle where we see price taking that high out, right? So let's go back to the 5-minute time frame. So when price gave that SMT, it was at the 9:30 drivers open, right? So we get a 90-minute cycle sequential SMT, which is really a SMT filled with a PSP on the 90-minute time frame, right? And then we get a CSD. And then what you do is when that candle closes and the next candle open, you enter there. You can put your stop loss at the high or EQ of the long wick, and that is simply how you would just ride price going down, folks. It is really, really that simple, right? So very, very clean trade, very, very high probability. And I took this trade, right? I think I took it in ES, right? Usually I take it in NQ, but I took it in ES because ES CSD before NQ. So I was like, I might as well just enter ES because I don't know if NQ is going to CSD very far away, because sometimes that happens when it CSDs and then you're waiting for the other asset to CSD, but the CSD takes place like here. Because look very closely there, right? This candle doesn't close below that low, right? But this one does close below that low. So I don't know if this second CSD, this one that was going to CSD here, was going to CSD like somewhere here. So I just entered immediately in ES so that I can just be a part of the move. And yeah, that's how I passed one of the challenges, right, that I took, right? Very, very clean trade. All right, so you can see that the 6 a.m. 4-hour candle then expands. And let's say you didn't catch that because you're not so advanced, right? You didn't catch the anticipation that this would be a C3, right? You can then see to the left that we still have a objective that is below the marketplace, which is the previous day's low, right? C3 has closed as an expansion candle. So what you can do is you can then follow the regular protocol that I just showed you, right? Of catching candle 4 opens, rallies into the range and trades to the draw on liquidity. So how would you do that, right? You would obviously first of all mark out your invalidation range. Right. So you want to find your refined key level in the lower half of this range, right? So if we then go to the M30, right, you are going to see that on all three assets we had a gap that I have marked out there, right? But all three assets straight into the gap. So we don't have any kind of like SMT fill. Although this candle is a PSP, right? The candle 3 of the gap is a PSP. We didn't have an SMT with it, right? So we then go to the M15 time frame, right? And on the M15 time frame, right, when price traded into the gap, right, it formed another PSP, and then the next candle fails to take out the high of that PSP. So it's a consecutive candle SMT with a PSP. That's a 2-stage we have there because this candle over here does take out the high, right? So as the SMT takes place, where you see this one take out the high and this one not taking out the high, you try to catch the wick of this candle, a CSD, to get in line with the move, and I'll show you that, right? So let's look at the M3 time frame, right? On M3, right, you can see when we failed to take out that candle's high, you can see that this next candle then closes below this candle's opening, right? So you would probably enter on the next candle opening, right? Somewhere here, right? And because this is a super long wick, you want to put it at around EQ of the wick, and then you target the previous day's low, right, as your target. So here you would just get a 2.3R. If you did try to extend it, you would get like 3R, right? So you would be lucky depending on where you entered. If you got a very nice entry, you could get away with 3R, and that is how you would enter in the continuation, right? Remember what I said, folks. Here we are not let me go to the 4-hour time frame, right? Here it's not like we are for the 6 a.m. entry that we showed previously. It's not like the previous C2 candle had like a gap that we were using, right? So this method that I'm showing to enter on the 6 a.m. candle right here that took place is a method that you really only want to use when you have a small wick, meaning that we have price rejecting at the high. You didn't catch the high because we do ignore the first 2 hours of the candle, but now you're catching an intra candle continuation. You only catch intra candle continuations when the wick is small. That is the wick of the candle supports expansion. That is why we had that entry that we entered at 9:30, right? And then this candle closed as a C3, right? And then we could enter this one as well to the draw on liquidity because the draw on liquidity was still intact over there, as you can see, right? So that is how you would enter on the continuation, but that is also how you would enter on an intra continuation. Please, 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 if you do not do it this way, you will lose, because there are going to be many times when you want to enter an intra candle continuation, but the wick is like super long. So the next candle is going to open and trade into that wick. And let's say your stop loss was inside of that wick of the intra candle continuation, right? Price would open on the next candle, stop you out, and then go in your direction. And you wouldn't like that now, would you? So that is going to be probably something that is frustrating for you. So you need to keep that in mind. How to enter on intra-candle continuations versus how to enter on actual continuations, the way I teach on the mechanical way of trading continuations to the drawn liquidity, right? Keep this in mind, folks. All right, so now we are on the silver triad, right? So you can see we have silver, we have XAG euro. You can also have XAG GBP, and I have gold as well, right? So as usual, you know that I don't compare gold with XAG euro. I don't compare gold with XAG GBP, right? And for this over here, I use XAG euro, and I use ICE as my data feed provider. Or if I'm looking at XAG GBP, I also use ICE as my data provider, specifically for the silver triad. And I compare XAG Euro and XAG GBP with silver futures. I do not compare those two with gold futures. I only compare gold futures with silver, right? I said this in the previous video, but in case it's your first time watching this video, I'm saying it again, right? So over here, you can see that price on silver trades into that high over there, which is a gap. And notice the gap is within 30 bars. So if I measure the gap high to where price gets into it, right, you can see that it is 13 bars, right? So it is within 30 bars, which is what we want to see. We're not trying to use some far away gap that is beyond 30, that is beyond 30 bars, right? We want a near-term gap that we can gauge. So we have an SMT fill. So this is the reason why I sold this day, right? And this was another trade that helped me pass another challenge, right? So I'm going to show you the lower time frame price action. So over here we have a daily. The daily just opens up, right? And I can see that on the daily time frame, the wick is long. So whenever you have a daily candle where the wick is long, you know that it is a day that does not really support expansion. Even though you are seeing a bearish signature, you know that it's going to have a very hard time expanding below its opening price. So your target should be either the opening price or very near the opening price, right? That should be where your target. You shouldn't be targeting like the previous day's low or something beyond that, right? Because this candle has a very long wick, so it does not support expansion, right? So let me show you that right now. So I go to the 4-hour time frame, right? On the 4-hour time frame, if you look very carefully, right, we have over here, let me just put this right there, gold, the 1800 candle, right, failing to take out the 2200 candle, failing to take out the 1800 candle, while over here the 2200 candle is taking out the 1800 candle. So I have that consecutive candled SMT, right? Also, right, if we also go on to the 6-hour time frame, you can see that we do have a consecutive candle SMT between the 1800 and the midnight candle. So that's SMT between Asia and London, right? And if you also look here, right, silver takes the 6 a.m. 6-hour candle, also does take out the high of the midnight candle. So we also have a consecutive candled SMT between the London and New York, right? So that is sequential SMTs, and you can consider that as like a two-stage setup. So we already have a two-stage taking place, right? I just wanted to show you guys that, right? We already have like a two-stage that is taking place, right? And on the 4-hour candle right here, right, this candle, when it opened, taking out the previous candle's high, what do you notice about the wick of this candle, right? You can see that it is a long wick. And what did I say for the previous setup? Whenever it is a long wick, you do not want to be catching an intra-candle continuation, meaning that let's say you got a reversal at the highs and then the thing is expanding and then you see price retracing into a gap within the same candle. You don't want to try to enter on that kind of entry. You rather wait for it to close and then enter on the next one. So I'm going to show you how to catch the candle, because the only way you can trade this candle is if you catch it at the high of the reversal, not some intra-candle continuation. Nope, no, this wick is too long to do that, right? Because the next candle will open up and probably stop you out. Like here, the wick is small, but it could have easily traded a bit higher. And if your stop was anywhere there, especially in the discount of the wick, bro, it's probably going to stop you out, right? So you need to pay attention to that as well. So we went from the 4-hour to the 15-minute time frame. The 4-hour was our narrative time frame, right? And now the 15-minute time frame, we're trying to confirm that 4-hour swing formation that we just were spotting, right? Because we're anticipating that the 4-hour candle is going to be a C2 closure, because we have SMTs added and we haven't taken out the previous candle's high as well, right? So we're anticipating that it's going to probably be a C2 closure, but it's going to be one that has a long wick, so we have to catch it at the high. And the way you catch it at the high is that you have to catch it at the actual reversal. So over here we have that larger SMT that we were spotting on the daily cycle, right? Between the candles. So you can see this is the high of London, price is taking it out here, but at the same time this high at 8, right, during 9 we also take that high out. So we have SMT taking place simultaneously, right? Because you can see in Dow that high price is not taking it out there, while it is taking it out here in ES and in NQ, right? So we have a two-stage taking place here, right, on the M15, which is why I am at liberty of using the M15. And just so you can see for yourself, let's measure the distance, right? You can see that it is 27 bars, right, from the high of the main larger SMT that we are viewing to this lower one, right? So this is a second stage that is confirming this larger one, right? The algorithm is actually considering this. So when this candle opens, trades higher, taking out that candle's high, I can see that it opened and gave like the SMT. So I'm anticipating that this candle over here is going to be a C2 closure probably, right? So I can try to find a CSD within this candle, right? So I'll go to the M3, right? Because I'm using the 15. Generally, what I like to do is if I'm using the H1, I'll just use M5. If I'm using like M30 or M15, I use the M3 or M1, right? So here we see when price gives the SMT, right? Then over here, right, you can see we close below the series of up close candles, right? Confirming a CSD. So that is where you would enter, right? But let's put the entry first. I want to show you guys something that is absolutely important, right? So I'm going to just place the entry there, right? Because remember that this candle is a long wick candle, right? So I want to show you guys something. Let's go back to the H4, right? Whenever you're dealing with a potential C2 candidate, right? But you can see that the wick is going to be a long wick. Oh, sorry about that. I'm not actually supposed to be trading XAG Euro. My entry is actually supposed to be on silver because I don't trade XAG Euro, right? So anyways, you take your Gantt box or your fib or whatever tool you use, right? I like using the Gantt box to get the 50%. Right? And then you mark from the opening to the high of the cracking correlation where you got your CSD in on that lower time frame, right? Then let's go back to the lower time frame. And let's zoom into that quickly, right? When you get that CSD, you want the CSD to lead to price touching the EQ. Why is this? Because the wick is long, right? So I'm just going to remove that. Because the wick is long. You want it to touch the EQ because, for instance, let's say that we know that the wick is a long wick, right? Let's say that we get the CSD and price is somewhere here. And then the 4-hour 6 a.m. candle closes. And then the 10 a.m. 4-hour candle opens. Because it's opening very, very near the high of this candle. If it's going to open, go high because it's a bearish candle. So we want it to open, go high first and drop. That open high might actually just take out this high, which is where we saw the CSD and we entered on, and we would be stopped out on the trade, and we would then see price go in our direction, which would not be nice now, would it? So you want to make sure that the CSD is so significant that it at least touches the EQ of the protraction range, right? And then what you would then do is that you can then enter knowing that, okay, that is a significant CSD, and I can trust that when price opens on the 10 a.m. candle, it's not going to stop me out because at least we had such a significant CSD that at least got to the EQ. Is that making sense? This is very important. If you don't do this, you're going to lose trades unnecessarily. Each candle has its own type of rules. And once you know all the rules, you will know how to navigate a lot of these candles and you won't be getting stopped out very easily, right? So that would be the first entry, right? Any other entry outside of catching it at the high, we won't take because the wick is too long, right? We would rather wait for it to close on that 4-hour candle and wait for the next 4-hour open, right? So as you can see, goes for 1:3. But let's say that you did not catch this entry and you wait for the 4-hour candle to close. Let's show you how you would enter in that. So we can see that this candle closes as a C2 closure, right? So it takes out the previous candle's high, giving SMT two-stage multiple ones, right? And you can obviously see we have internal range liquidities to deal with. Now, if you obviously take the swing low, right? The swing low to the high, right? You can see that this gap exists in discount. So we're going from external range liquidity to internal range liquidity, right? That gap. Now, what is your framework? External range to internal liquidity. What candle are you going to be trading? Well, the C2 just closed, right? It's confirming the framework. So we will be trading C3, right? As a continuation, right? So I'm just going to mark that there. Internal range liquidity, right? I'll just take this out of the way so it's not a distraction, right? And then you mark out the C2 candle because you can see the close is lower than the open. So I'm just going to mark out the entire range. And I want the next candle to get rejected in the lower half with a gap and some kind of SMT confirming that gap, right? So we're going from the 4-hour to which time frame? Either the H1, the M30, or the M15, right? So let's first check the H1. I'm just going to pretend like I'm doing this actually live, right? So on the H1, when the 10 a.m. opens, I don't see any gap there. So I would then go where? To M30 to check if M30 has a gap. M30 on this candle didn't have a gap at the time, so we go to M15, and then when we go to M15, we see that there was actually a gap there, right? And we notice that when 10 a.m. opened, right, it takes out the high of what would be this gap right here. So here, this one is failing to take out the high, while this one opens and does take out the high. So that's SMT fill. And then when the candle closed, it also closed as a precision swing point. So that's a two-stage setup at our refined key level. So we went from the H4, then we went to M15, we got a refined key level, right? And we got a two-stage setup at that. So now we can go to which time frame? The M5, M3, or even sometimes M1, right? But I'll use M3 in this case, right? Because once that candle closed, sorry, let me go back to M15 to check what time the candle closed, because it closes as a PSP, so we will be trading the next candle. So starting from 10:15, once this candle closes as a PSP, confirming it as a two-stage, from 10:15, that is when we would be looking for an entry, right? Can you see, guys, it's the same thing, right? I just try to make this video more clear, right? So from 10:15, right, you can see this candle is a bullish candle, right? And as a price then closes past this candle right here, right, I would more so, because I can see that price is really in a consolidation here, so I would actually wait for price to just go down a bit more, right? Or I would look on M5, right? Sorry about that. Right, so on M5 it looks a bit better, right? So from 10:15, right? So immediately this candle opens on 10:15, right? In fact, even when it closes here, right, you can see these consecutive candles right there, right? You can see it has SMT within that range of the consecutive candles. So that candle right there, you could have entered as it closed, right? Stop above the high, right? Because it has an SMT above it, so it's fine. And right, that's how you would catch the continuation, right? Usually I target like a 1:3, and you can see we get that, right? But that's the internal range liquidity for those of you who really like to target. Those of you that don't have any consistency rule that is limiting you, look, the setup, the continuation, you didn't even catch it from the entry. You're just catching it from the continuation, and that is a 1:6. I kid you not, right? So that is how you would enter, right? So pay attention to the candles to know what kind of candle, and don't rush it, right? The next 4-hour candle will always give you an entry if your objective is still intact, right? So that is how I caught it from the high, right? Because usually I like to go to the gym, so if I can catch it very early, I don't have to sit here and wait. I can just close my computer and go to the gym or whatever, right? So that is how I took the trade that day as well, right? Alrighty, so now this is the last setup that took place now. On the weekly daily, right, there wasn't really anything going on, right? But there is a mechanical process that I follow. Now I want you guys to know that not every single day that you come into the market, you're going to have a bias. Some days you have to wait for the market to show its hand, right? And this is one of those days. And if it happens like this on any day, I will follow the exact same protocol. So another thing that I probably will teach about is daily profiles and candle profiles, right? That I will probably cover in the future, right? But what you need to know about this day is that when this is the Asia session, this is the start of the day opens up and just trades higher, right? It doesn't trade lower, take out any relevant low within the marketplace. It just trades higher, and it remained high even in the London session as well. So I want you guys to know that the Asia session, the London session, and the New York session, all three of those sessions can't be bullish expansions. Like, all three sessions can't all go the same direction. Like, you're gonna have some sessions retrace and then another session expand as continuation. All sessions cannot be a expansion in the same direction. So even though I came into this day and I was bullish because I saw like these highs, I was like, no, there has to be some kind of pullback taking place, and I will always do it this way in any situation. So just so you know, it's not a situation where I'm cherry picking, right? The day opens, Asia session expansion, some of London session expand, and it stayed kept consolidating on the 2 a.m. candle right into the 6 a.m. We have this gap below the market. Remember what I said in the previous video, whenever I'm looking for a buy signal, I don't want to see a near-term gap. And all three of the correlated assets did not trade into that near-term gap. That is not a good place to buy. So I would expect this day to either reverse or at the bare minimum give me a retracement. And I'm very sure within that retracement, I can easily catch a 1:3 on the lower time frames. This is what I'm going into the market thinking about. So this is one of those situations where you are going to trade against your bias because the market is overextended, right? And it will snap back like a elastic band because it needs to at least retrace into something if it is going to continue, so you can be able to catch. So coming into this day, when I saw the 2 a.m. stay there, doesn't retrace, and then the 6 a.m., the beginning parts of it were consolidating, and then it takes out the high, and I can see that the wick is not even that long. I know that it supports expansion, and where would it really expand into probably this gap. So what are we doing? We're going from external range liquidity, right, to internal range liquidity, right? And we're anticipating that the 6 a.m. candle will be a C2, and potentially we could also trade the 10 a.m. candle as a C3 continuation, right? So like I said, every trade, this is what I'm envisioning. What is my framework? Check. What is the candle within the framework am I trading? In this case, a potential C2, right? So I'm always thinking these things when I'm taking trades, right? So to confirm the framework, I obviously use swing formations and what? SMT. This candle opens up, rallies above the high. So it's potentially what kind of swing formation? A C2 reversal into expansion, right? So the way we confirm a 4-hour swing formation is with a 1 hour, a 30-minute, or a 15-minute swing formation. So let's go to the 1 hour to check, right? And on the 1 hour time frame, right, there was an SMT taking place, right? So if you look at this candle right here, price on this candle takes out that candle's high, right? It takes out the candle's high right here, while here it's failing to take out that candle's high, right? So this candle is a bearish candle, while this candle over here is a bullish candle. So we already have a 2-stage, and we're taking out the high of London. Remember what I said, folks, in the slides. You could have a situation where you have price take out, trade into your key level, which is the high of the previous session, and then form a PSP that is a 2-staged PSP. So we don't have a SMT with the framework's external range liquidity. We don't have like a SMT between this high, but we have a 2-stage PSP confirming that price wants to reverse from this high. Go back to the slides, right? I show something like that there, right, in the SMT section of the slides. So when this happened, right, and this candle closed as a PSP, it confirms that price wants to potentially reverse. You can then trade the next candle because this candle closes as a C2 closure, right? This candle takes out the previous candle's high, closes back inside the range. So the next candle will open, trade higher, and then trade lower, right? Now notice here that can you see that this candle really trades past the EQ of this candle's range? This is one of those situations where you have to use your discretion, because look at where ES closes, right? ES, it closes back into the range, but it's not really an expansion candle, right? But you can see visually that this candle is failing to take out that candle's high, right? And the wick is small. The whole point of marking the invalidation is to ensure that we are trading with a small candle, and ES's wick is small. So I don't mind seeing a long wick here on NQ like that, right? Because ES wick is small, and even though it is past the EQ of this candle is not really like an expansion candle where price is opening here, right? But you can see that the wick is small. I hope you guys get what I'm talking about, right? But anyways, we have a 2-stage here, right? We have a 2-stage. And even on this 9 o'clock candle, look, Dow Jones is even taking out the previous candle's high, while these ones are failing to take out the previous candle's high. So that then allows it to have that long wick on NQ, even Dow Jones. It doesn't really matter. It's confirming everything, right? So you guys should always use your discretion. Sometimes it is mechanical, but sometimes there is just a little bit of discretion that you want to apply, right? So when that happens and this candle closes, we're looking to enter on 9, right? And we have a C2 closure. So we go from the 1 hour to which time frame? The 5 or the 3 minutes. So I'm going to go to the 5 minute, and I would like to see a CSD around there, right? Now we are trading indices, right? We are trading indices, and whenever you get like a cracking correlation, and that cracking correlation just happens at like 9, and 9:30 is just like maybe less than 30 minutes away, it's best to wait for the 9:30 news driver, I mean the 9:30 driver to first come out, because sometimes it might spike you. So over here you did get like a CSD, but look what happens on 9:30. It spikes the high of the CSD. So you want to see, like, whenever you get a CSD and 9:30 driver is like a few minutes away, wait for the 9:30 driver to first come out, right? And then see what happens, right? So over here you can see it spikes the high, right? So let's go to the 3-minute time frame. When 9:30 spikes that high, right, and then trades lower, right, you can see, and then it forms a gap. You can literally enter on that gap, right? So that could be your entry on NASDAQ, right? You can put your stop like at the EQ of the long wick, right? Or you can even just like, you see this second entry right here, as price trades into the gap and then gives you that second CSD, you can enter on that one as well, right? But to be safe, right, you enter there, and you can see it gives you like way more than 1:3. It almost gives a 1:5, 1:4.8, right? So that would be how you would enter for this trade, right? So then, as you can see, price then expands, right? Now the 10 a.m. candle, right, if you go to the 4-hour time frame, right, you can see that we were not really bullish on this day, right? We were more so and we were not really bearish on this day. So this trade was a retracement. So to trade the next candle into this gap already is not really advisable, because you don't want to be trying to really sell when you're already in a higher time frame gap like this, right? So it wouldn't be advisable to trade when you're already in some kind of support level that can push price higher, right? So that is why this day, if you caught it at the wick, which is what I did, right, at the high, right, it would have been very beneficial, and you would have caught a nice retracement, because as you can see, price then plays around and eventually trades higher again, right? So this was a sell. It was a successful retracement that we caught. So you can see that you can catch retracements. You don't only have to catch expansions. And I used to think in the past that if you're trading retracements, you're probably going to have a low win rate, and that is not necessarily true, right? You can successfully trade retracements and still be consistently hitting your targets that you are targeting. You just need to be able to keep the context in mind, and also know that it's obviously not going to sell forever or sell very much. So you have to really be realistic in where you're targeting, right? So that is it for the setups, right? If you guys have any questions, always leave them down. I'm telling you, it's the same thing over and over again. Compare what I was showing you in the previous video to this video. This one is more concise, but if you think about it, it's the same thing that I showed in the previous video. This stuff is extremely powerful and mechanical. So much so that you can literally do the exact same things every week. And for everything you do, there's a reason behind it. When the market does this, you do that. When it does this, you don't do this, but you do that. You see, it's a very mechanical process of looking at the market and engaging in moves, right? Trading continuation candles, trading reversal candles, right? Looking back on the previous candles range, getting your refined key level, looking for price to reject inside that refined key level in the lower half to get to your objectives, right? Very simple stuff. Internal to external range liquidity, understanding the different kinds of SMTs. It might be a lot of things to you, but trust me, once you've learned and mastered everything, it's so simple, to be honest, folks. So make sure you guys like, comment, and subscribe, and we'll talk very much in the future. Peace.